Well, good evening and welcome to this live stream on the 10th of January 2023. Martin North from Digital Finance Analytics here. Great to have you on board this evening, and we're going to have an interesting conversation tonight about mortgage stress, household finance, and my various scenarios. And just on the way into that, I will, of course, as normal, just remind you that we don't provide specific financial or legal advice. This is a general conversation only. That the chat room is moderated, so please play nice in the room. I do encourage you to share your thoughts and opinions, and it's part of the community experience, so enjoy. At the 10th of January 2023, if you're watching in replay, if you want to get my attention or if you want to ask a question, please do use @WalkTheWorld to make quite sure that I see it. It goes into a separate queue, and that means that I don't lose your question. And I've also enabled Super Chat, which means that you can, if you want, get your question top of the list, or indeed, if you'd like to make a contribution to what we do around here, it's always greatly appreciated. We don't do this for profit. We do this because we think this is a really important conversation to be having. And particularly in the current environment that we are in at the moment, when there are so many uncertainties and, frankly, so many things whizzing about, so makes you wonder what may be going on next. Anyway, let me now just start by taking you through a few of the major items of news that we've had in the last couple of days. Quite a lot of information to go through, and hopefully this will be useful in terms of just seeing some of the things that are really forming the critical dynamic at the moment. The first thing I think is CoreLogic. So CoreLogic said prices on average are falling fast, and they're now saying an 8.4% drop, and they've shown it in terms of the number of months. This is the chart they've put out very recently, 8.4% from the previous peak. So they basically said that this is actually a significant record-breaking national decline, and they also expect further price falls in the months ahead owing to the recent cycle of rate hikes that have risen at the fastest rate pace on record. And it's worth just me emphasising again, of all the things that influence home prices, interest rates and credit availability are the critical ones. And so what we're seeing now is as rates are rising and borrowing power is being reduced, and that means that essentially prices are falling, and that will go on. So even if rates don't go any higher but stay where they are, that's still enough to put a significant dampener on the party. And as CoreLogic says, a 300 basis point increase in the underlying cash rate over just 8 months has resulted in a rapid reduction in borrowing capacity, lowering the amount buyers can offer for homes, and in addition, constrained borrowing capacity, higher interest costs may be dissuading potential buyers altogether. And I'm certainly seeing that in my surveys. We'll come on to talk about that in a little while. Now, here's another piece of information. Just in terms of their release from the 31st of December, highlights that not all markets are behaving the same way. So if you look at the annual movements, 12% in Sydney, 8% in Melbourne, both falls, where Adelaide is 10% higher on an annualised basis. And Canberra is just down a little, 3.3%. But on a quarterly and monthly basis, again, the trajectory is quite different. And in fact, on a monthly basis and on a quarterly basis, it's Brisbane that's actually falling the most. And of course, this is contextualized by the very strong run-ups that we had in the 18 months or so through COVID, ultra-low interest rates, lots of easy money, pulling out money from superannuation, the government handouts, etc., 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 home builder, all of those things created the problem. And now, of course, we're reaping the whirlwind with what's happening to interest rates and therefore to home prices. And therefore, the consensus must be that there will be more falls ahead. And we'll talk a bit about that in a little bit as we go forward. But it's also worth highlighting that averages mask. And, you can look at combined capitals or combined regions, or you can look at different locations. But of course, units and houses and different properties in the same locations are behaving differently. So these averages don't tell you much at all, really. And I'm get very frustrated with all the coverage of these high-level aggregate movements. They don't really tell you much at all. You need to go granular to really understand what's going on. And of course, CoreLogic isn't the only provider of information. There's PropTrack and there's a few others too out there. And if you compare Domain and PropTrack and CoreLogic, they don't actually agree on how much movements there have been. So the whole question of where prices are and where they're going and how much they've fallen is much more complex than the high-level headlines that you see in the mainstream media. Of course, they're just trying to get eyeballs, whereas actually there's a bigger question here about what's really going on. So we're going to probably see a little bit more of that ahead. Now, another issue, of course, is the rental crisis. And this is, again, from CoreLogic. Very concerning that the rents across the nation soared by 10.2% in 2022, according to CoreLogic. That's off a record low rental vacancy rate of just 1.2%. And the number of homes listed for rent across the combined capital cities is currently the lowest on record. So one of the things that we've seen in our surveys is a lot of people who had investment properties to rent have actually sold them or in the process of selling them. Why? Because they had this massive capital appreciation over the last 18 months. They're seeing that now drift away. And whilst they can get somewhat higher rents, the costs of the investment property are such that the gross rental yield might be up a little bit. That's, of course, the relationship between the price of the property and the rental stream, assuming it's fully let. But the net rental yield is continuing to decline. So many people who actually have got investment properties are losing money hand over fist at the moment. And with capital appreciation going negative, in other words, they're losing money from a capital perspective, then the renting situation is pretty dodgy. And of course, we've also got the other question here, which is we've got more migrants coming into the country. Many of those migrants will require rental accommodation. So there's significant bottlenecks and significant demand. And we're also seeing some people being kicked out of their rental property through the Christmas and New Year period to allow it to be let to holidaymakers as well. That's another factor in the mix. So there's a lot going on. And some of the high-level numbers, again, really don't tell you the full story. Now, just on a broader context, it's worth just reflecting on this, that real wages, according to the Statement of Monetary Policy from the RBA, will fall in real terms out to December 2023. So we will continue to go backwards in real terms. And that's very important. So whilst people are talking about improved wages, the wages are still well below inflation. And everybody's expecting that to continue for at least the next couple of years. So net, people are going to be worse off rather than better off. It's something that a lot of people have forgotten, I think, in all of this. And bear in mind that we've also got the issue of inflation, and that flows into the various costs that people are spending, which is why looking at my cash flow is quite important in my surveys and through the mortgage stress, which we'll come on to shortly. The other thing to bear in mind, of course, and this is just to re-emphasise what we've shown before, that the projected expiration of fixed-rate loans comes to a peak in June. The RBA is thinking, I think, about a quarter of all loans will be reset. And typically, the old loans were at about 2%. The new loans are around 6% or maybe slightly higher than 6%. Depends a little bit on the assumptions that you make. But they also make the point that another 38% of fixed-rate loans will expire in 2024 and beyond. So this is a big deal because it means a lot of people are going to be surprised by significant rate rises. And of course, the question is, what do? Do you try and refinance early, or do you wait till the end and see whether rates come down, or what do you do? Very interesting conversation there to be had about how people prepare for those very significant events. And in my surveys, a lot of people said, well, I'm going to get through Christmas and New Year, and then I'll start worrying about it. So people could well be worrying about it now from January, February, March time, depending on when the next roll actually happens. And by the way, in my surveys, quite a few people are not quite clear when their fixed loan is due for reset. They're expecting the banks to communicate with them and tell them. So I would say plan ahead, find out plan ahead and know what your current rates are and look at what your options are, because what you should be doing is starting to put money aside now at those higher rates to prepare for the rate rises later. But maybe that's me being too logical. Just worth saying that the 30-day interbank cash rate from the ASX is now talking about a peak rate of 3.9% in October and November of this year, and a small fall to 3.68% in June 2024. So you can see here, this is a dotted line. This is where the cash rate currently is. So the markets are thinking that there will be significantly higher rates ahead, and then it will stay on the high plateau and then will come down. Now, it's interesting that, of course, some analysts are actually arguing that the Reserve Bank is unlikely to lift above the 3.1%. So in other words, they've done. Others are saying they'll lift one more time. Others are saying maybe a couple of times, maybe 3 times. The market is saying, about maybe another 3. And then they're saying rates will stay high. Now, my argument will be, it's not really what the RBA chooses to do, it's what the Fed does, because what the RBA does is going to be mirrored and influenced by what the Fed does. And so we need to understand what the Fed is thinking to be able to understand what the RBA might be doing. But the assumption that rates are going to actually drop later in this year flies in the face of all the evidence from the markets. And yet, of course, a lot of economists are saying precisely that at the moment. Well, how right have they been over the last year or so? So why are they right now? I'll leave that as a hanging question. Now, let me make this point here, that the Fed is very important to look at. And so yesterday, Bostic and Daly, they're the two of the Federal Reserve officials, said the central bank will need to raise interest rates above 5% before pausing and then holding for some time. We're going to have to hold our resolve, Bostic, the president of Atlanta Fed, said. He said that the Fed is committed to tackling high inflation, and this warrants raising interest rates to a 5 to 5.25% range to squeeze excess demand out of the economy. And that's one reason why the US markets were down later in the day, because they were reacting. And of course, as I made a post about this the other day, where you've got the Fed being interpreted as being a little bit more bearish, in other words, not lifting rates as high, the markets tend to say whoopee, and then they go higher because they argue the Fed's pivoted. And then when the Fed comes back and says, no, we're serious, we're still going to do this, then the markets say, oh, okay. The critical question to understand here, and this is one that I think a lot of people, again, have lost sight of, is earnings. Future earnings is the critical question, because the stock markets are way overvalued. They're still valued for perfection. And that means that if earnings are going to be lower because of recessionary tendencies and because of other factors, then that may well mean that the ability to be able to tackle all of these issues and to drive the markets at the same time goes in 2 directions. And the Fed said several times, if the markets need to come back, that's actually a good thing. So there is a fundamental dichotomy at the moment between what the Fed is saying and what the markets believe. And that's one of the reasons why the markets are sort of up and down all over the place. But I think this particular extract from Bloomberg is quite important. Now, just in terms of other information, the building approvals that came out yesterday showed further drops. So it fell 9% in November after a 5.6% decrease in October. That's the 3rd consecutive month of declines. And they've fallen 21.7%. Private sector dwellings excluding houses decreased 22.7%, and private sector houses fell by 2.5%. As always, it's the high-rise apartments that are the volatile ones. That's because, of course, when you apply for approvals for high-rise, it's not one apartment, but it'll be 100 or whatever, so it moved up and down quite a lot. And it's interesting that, again, the ABS said that approvals fell in New South Wales, down significantly, 18%, Western Australia down 70%, Victoria down 12%. There was some increases in some of the small states, but this is a very important factor, and of course it's another negative in terms of actually dealing with some of these supply-related issues. Now, of course, whether in fact supply issues are really as critical as many argue, I would argue it's credit availability that's the critical thing rather than supply. And there's 1 million spare properties in Australia, but hey, don't let that get in the way of a good story. And the other thing that came out today was household spending momentum. So this is from the ABS, and it showed that momentum for transport, hotels, cafes and restaurants, and furnishings and household equipment all are down a little. So this is an interesting leading indicator potentially of weaker economic activity ahead. But we will see. One of the other things that came out today was this from the Mortgage Choice Group, who surveyed 1,000 survey respondents, and they said about 1/3 of mortgagors plan to refinance in 2023. That's pretty significant, and it's certainly in line with some of my research. And interestingly, a lot of those who are looking to refinance are also looking to draw further equity out. Equity mate is a very significant factor in all this. Over the last year, about $90 billion has been drawn out through refinancing and pulling equity out of property as part of the refinance. 90 billion. So that's in the same quantum as the COVID stimulus. And that's one of the reasons why households are still spending quite freely at the moment in some areas, because if you've got equity in your property, you pull the equity out and then you spend it. So that's one of the factors to bear in mind. And of course, at the moment, there's very little supervision of equity drawdowns through refinance. And interestingly, some of the lenders are not actually doing a full new underwriting and analysis. What they're doing is taking the previous analysis and saying, well, if it was okay for them, it's okay for us. So that's another weakness in the underwriting processes. I think we're going to see some grief coming from this a bit later on. And just in terms of more grief, ASIC said that the first quarter in 2022-2023 saw a construction collapse underway, with 605 construction companies going under, and construction represented 26% of all insolvencies in the country. So far this year, though, the sector is running at 30%. The nearest competitor, the beleaguered accommodation industry, is topping out at 13%. So the construction sector is really feeling it. And of course, that's because we had a profitless boom in construction. We had home builder and all of those things. And then we had problems getting people to work in construction, as well as all the goods and services that are required to enable the construction process to work okay. And of course, things like imports of materials were also badly affected through COVID and are still badly affected, particularly now with China going up through its next phase of COVID. So I think that's a very important factor to bear in mind in all of this. And here's another recent example. Western Australian example of a construction company collapses under the weight of labour shortages and huge price hikes. Yeah, not surprising really. And yet, of course, the industry is also calling for cheap loans to help developers kickstart projects. So the solution that the industry has all the time is we need more government help. We need more government help to kickstart the construction sector and the building more houses. And it amazes me that at this part of the cycle, they're still calling for yet more government help. And in my surveys, interestingly, a lot of people are actually believing that the government will save the property market. So they'll do another cycle like through COVID with, JobKeeper or something, or Mortgage Keeper, we'll call it this time, something to help people through this cycle. So the expectation is government's going to help and bail us out again. And of course, Spain, for example, they're doing that now. So they're helping Spanish mortgage borrowers by covering some of the costs of the higher interest rates. Now, I don't think that's likely this time. I think given where the budgets currently are and the fact that there are a lot of costs going out and a lot of pressure on the budget, my own view is there's less capacity for the government to actually bail things out this time. But my feeling is that we probably will see some release from Emptor of the buffer. The 3% will probably be dropped quite soon. I wouldn't be surprised to see some messing around with the term funding facility, or maybe the extension of it, or something to keep the cheap funds in the system, because of course banks should be now starting to plan to repay those very cheap funds, $188 billion. And that means significant pressure on the banking system. So there's a lot of issues in play here. But as I say, a lot of my surveys show a lot of people are saying, oh no, the government will save us. We'll see. And just stepping back, of course, the IMF says recession in a third of the world economy is likely in 2023. They talked about rolling recessions. They also talked about the fact that Australian housing was out of kilter. I covered that in an earlier post. And this is another interesting chart. I saw it today. The S&P 500 EPS revision sentiment is the most negative since 2020. In other words, the markets are now starting to revise down the earnings per share estimates. I think this is a very significant factor, going back to what I said about markets and earnings expectations. The fact is, it looks to me as though we have a significant factor here, which means that now markets are beginning to think that maybe EPS will be lower. If it is, then the markets will need to come lower because the current market valuations are way too high. Okay, so let's go on to the next part of the discussion, and this is, of course, my core market models. You'll be familiar with this if you've watched the shows before, where we survey households, and then we put it into our model and pull information out. We can slice and dice the data, of course, and we can also run it through our scenarios to have a feeling of what may happen. It's not a prediction, it's just a different sensitivity to what may be ahead. And home scenarios, where we look at mortgage stress, price trajectory, the buying and selling intentions, the migration, the economics, put it into the core market model and our scenarios, and then we can look at it at the postcode level. And we run different scenarios, and we'll talk about those in a second. And on the back of that, we can make some estimations of where things may go. And I will just briefly mention, if you want an individual conversation about a particular suburb, I do run my one-to-one service. I'm quite busy on this at the moment. A lot of people are wanting some guidance and help. I can look at underlying data in the postcode. It's not financial advice, of course. It's just a general observation from my analysis. But I can look at stress, home price trend data, and also some of the trends ahead based on the modelling. And you can have a conversation via Zoom or a phone call up to an hour. There is a cost involved because of the research. And if you are interested, you can contact me by the blog. The links are below. Send me a message. And we're booking typically about 3 to 5 weeks ahead unless there's a really urgent conversation to be had. Now, let me move on to a definition of stress, because it's very important to understand how I define stress. I define it here as cash flow, money in, money out. Others out there talk about 30% of income or taxable income or through some sort of underwriting metrics, but we define stress in cash flow terms. What it means is if households have more outgoings, excluding one-off discretionary items and income, we just find them as stressed. If they have a mortgage, they're in mortgage stress. If they're renting, then they have rental stress. And investors with cash flow pressures can be identified as stressed investors, and we can also aggregate all the data to look at the total financial stress at the household level, and we look at it at a postcode level as a percentage of households and the count of households. Now, I use the count as my baseline because it stops this issue of a very small number of households in a postcode where there are not many households registering as a very high percentage. So the count probably gives a better representation. That's what I'll be using tonight. Now, tell you about the latest modelling. So this is as at the end of December. And the first thing to say is that rental stress is still way up there. It's at 60.85% of all those renting. Massively high. You can see the run-up in recent times. It's come back just a little, partly because of the the wage rises for low-paid workers that was made a few weeks ago, and also the fact that some people have moved into cheaper accommodation simply because they can't afford what they were paying before. Mortgage stress is 45.8% of households, and that's still very high. It's pretty much knocking along at the highest levels, just a little bit below where it was a few months ago. Again, it's partly to do with the refinancing and partly to do with some of those wage rises that have come through. 45.8%. In February 2020, before COVID, we were at 32.9%, so there's a considerable rise. And the third factor to bear in mind here is the RBA's household debt ratio, now at 189. Now they reset this number quite recently and recalculated quite a long way back, but it's higher than it was. And remember that this includes all households, whether they're borrowing or not, and small businesses. So if you want to get a true estimate of the debt to income ratio, you need to multiply it roughly by 3, because roughly 1/3 of households actually are people borrowing with a mortgage. So very high. And of course, we hold the prize for some of the highest, most leveraged households around the world. Something the IMF talked about just over a week ago in one of my shows. I covered that. Now, before I go into the more specific detail around stress, I'm just going to have a quick look over at the conversation here and see whether there's any burning questions that have come in. If not, we'll just fly on through. Looks to me as though a lot of good conversations, but nobody's thrown me a burning question at the moment. Good, okay. A good comment though. I'll just put that one up. If mortgage stress is at 45.8% now, then it's probably above 6% by September. It's certainly going to go higher. Yeah. And the issue is cash flow. You know, like I said, wages growth is going to be negative in real terms. Inflation is still very high. Interest rates are continuing to rise. More people are refinancing and pulling equity out of their property to enable it to come back. So it is pretty concerning. Now, Jason asked a very interesting, and thanks for the super chat. Do you think APRA is running some ADIs in secret mode as they could by law? If APRA is running some, do you think the ones not managed by them do better in the light storm, given them power to do so? Yeah, there's a lot going on below the waterline. What we do know is that the banks are lobbying quite hard to allow more extended terms, 40-year mortgages. And there's also some conversations which seem to be that APRA are quite happy with supporting, moving people to interest only and helping them to sort of work through that, and then paying down the mortgage using superannuation later. Now, those two strategies to me seem a bit shonky at the moment. What we don't know is how much detailed supervisionary activity there is under APRA. APRA basically sits there and waits for the banks to come and sort of, share information if they've got a problem. APRA is not very proactive. APRA is not auditing what's going on inside the banks at all. So my question is, do APRA know what's really going on? And it's interesting that in my recent conversations with a couple of the banks, when I show them the granular information that I've got about the way that households are behaving, they walk away from that saying, well, we've got a portfolio view. We don't need to worry about the granularity because our portfolio view allows us to offset these things. So I fear that some of the banks are actually in the situation where what they're doing is making high-level decisions, looking at the net losses, which are still very low at the moment, but not actually understanding the full risks in the portfolios. And as I showed the other day in one of my recent posts, some banks like CBA and Macquarie and ANZ are chasing volume quite considerably, others less so. So I think there's quite divergence. Some of the regionals are dialing back, and some of the foreign banks, like ING, for example, are dialing back. So very different behaviours that I'm seeing at the moment. So I'm not sure, though, how much APRA is across this. All right, let me just go back to the mortgage stress, and we'll just go into some of this in slightly more detail. So this is as at December, and as normal, I look at it across the states, and the percentages here are the proportion of people in mortgage stress, rental stress, investor stress, and financial stress. And if it's yellow, it means that there is more stress than last month. If it's blue, there's less stress than last month. And if there's no colour, then it's the same as last month. So overall, the mortgage stress number and the rental stress number and the investor stress number are all pretty much the same as last month, give or take. There's slightly less financial stress. Within the mortgage stress area, the ACT and New South Wales saw it coming down a little, along with the Northern Territories. But Queensland and South Australia saw an increase. Tasmania saw a decrease. Victoria saw an increase. And Western Australia saw just a slight decrease. For rental stress, there was a rise in the ACT, New South Wales and NT, a slight fall in Queensland, a rise in South Australia, a fall in the Tasmania, a fall in Victoria, a rise in Western Australia. For rental stress, there was a rise in Northern Territories, South Australia, Tasmania and Western Australia. And the aggregated view, net, things were slightly better in the ACT, New South Wales, Northern Territory and Queensland. They were considerably worse in South Australia and in Western Australia. And they were slightly better in Tasmania and Victoria. And slightly better, marginally better. But, just to give you a quantum, 1.72 million households in mortgage stress, 1.8 million in rental stress. I think the rental stress story is the really concerning one. The stressed investors, 608,000. And the total financial stress of the 9.7 to 9.8 million households in Australia at the moment, just over 4.2 million, have financial cash flow issues. So about half. That's a big number. If I then look at it from a segment basis, and again, here what I've done is I've highlighted the highest in each of the categories. So this isn't talking about the movement from last month, it's just the absolute highest. So young growing families, including a lot of first-time buyers, those on the urban fringe, and those who are also close to the edge of town, but with less income and means. They're the ones with the highest proportion, and some of those numbers are quite big. So 461,000 disadvantaged fringe, compared with 282,000 in mortgage stress among young growing families. And the rental stress category, what's interesting is that we've had up till this point the multicultural establishment as the leading stressed, but now we're seeing more mature families getting more difficulty because the cash flow pressures are getting more significant and rentals are rising. Wealthy seniors are also struggling too, as well as young affluents, and some young growing families too, they're 64%. Looking at investor stress, we find that young affluents are the ones who are struggling the most. So these are people perhaps who've been less experienced in running investment properties. We also see there are some ex-litigation professionals. So these are people with multiple investment properties struggling, but that's more to do with cash flow because of the fact that the mortgage rates have really risen dramatically, and that's put a lot of people into difficulty. And so overall, 51.97% of battling urban, 50.35% of young affluent, and 63% of young growing families are actually in cash flow pressure. So that's very high. And we just quickly look down the list. This is mortgage stress. Liverpool, Campbelltown, Western Australia, Tapping, places like that. Toowoomba in Queensland, Hoppers Crossing, I should say, and Tarnet, Narre Warren and Fountain Gate, Roxburgh Park, Craigieburn, Mickleham, all those areas, Berwick and Harkaway. So these high growth corridors again. Camden, New South Wales, Box Hill, Marsden Park, all those areas around there. Pakenham, Merriwa, and then we go to regional areas like Ballarat and back to Cranbourne. So we see very significantly a large number of those in mortgage stress. This is looking at the count of those in mortgage stress in these high growth corridors. If we look at rental stress, centre of Melbourne is still up there at 13,000, but then we see Toowoomba, Liverpool, Southport up in Queensland, Wentworthville, Campbelltown, Zetland and Waterloo, Mount Druitt, Bundaberg, Blacktown, Ipswich, Upper Coomera, and Millers Point and Sydney itself. So considerable numbers there. If we look at the investor stress, Melbourne again is right up there. So a lot of stressed investors are struggling because of this issue about the cost of the mortgage. Then we go to some Western Australian areas, Newton in New South Wales, St Kilda, Cranbourne, DY, Northern Beaches, Randwick, Surfers Paradise in Queensland, Surrey Hills, Carnegie, Lane Cove, Hornsby, South Brisbane and Toowoomba. So you see there are a few changes from last month in this list at the moment. And then if we go to financial stress, Toowoomba has the prize of the most stressed households in the country at 24,000. Then Liverpool at 24,000 again. Campbelltown 23,000. Hoppers Crossing and Tarnit at 18,000. Melbourne 17,000. Mount Druitt and areas around there at 16,000. Craigieburn, Donnybrook 15,700. Springfield and places like in Queensland. Tapping in Western Australia. Cranbourne, Ipswich, Point Cook, Werribee, Derrimut, Southport, Ballarat, Blackdown, Pakenham, Fountain Gate, Camden. So you can get a bit of a feel there of the areas where the total number of people in difficulty are their most significant. And, you know, we've seen these numbers wobble around a bit, but they're not going down, they're going up. If anything, they're going up or sideways. What people are doing is trying to refinance. They're trying to actually grab equity to be able to give them more wriggle room. And what we're also finding now is that there are more people who are what I call mortgage prisoners. So they are people who are unable to find a mortgage, find a cheaper mortgage, because they're locked into a more expensive one. So some of people in these stress categories with a mortgage are paying quite a lot more than they perhaps should. Other people are looking to refinance, or trying to find other work, or trying to find ways to save money, or to put more on credit cards, or buy now, pay later, or those things. And ASIC, I don't know whether you saw, ASIC made a comment the other day saying they're really concerned about the number of people turning to buy now, pay later, using credit cards, using payday loans and other forms of short term to try and actually get through. So this is a significant and growing factor. But as I keep reminding everybody, this isn't going to blow up overnight. This is going to take a long, slow burn. So you would expect to see more people getting more difficulty over the next few months ahead. Rates will continue to rise. The fixed rate problem we discussed earlier on will start flowing through. So more households are going to be in significant difficulty. At least that's how I read it at the moment. Now, we can look at the mapping, and let me just set this up correctly so I can make sure that it's working the way it should. Do that. Okay. So this is just another way of showing the same information. This is Sydney, of course. And this is the household counts down at a postcode level. And you can see that in and around the Sydney area, you've got this Western Sydney swathe from Blacktown down through Camden, Liverpool, Campbelltown, and further in places like Bankston too. This is where a lot of the issues are. But if you drill in a bit closer to Sydney, whoops, turned the knob the wrong way, let's go the right way, there you go. You can also begin to see that there are some variations closer in as well. And whilst the counts might be a little lower, even some of the more affluent suburbs are still counting a reasonable number. Look at Mossman, Lane Cove, Rye, places like that. If you go up to the northern beaches, there's a few there. Up DY, places like that. And if you were to go further up the coast, up to the central coast, there's some there as well. Now the numbers may be a little lower because the population density is lower, but nevertheless you've still got quite a few areas around here where in fact there are considerable issues. Now I will go and look at just Victoria, just because I can. And so we start in postcode 3000. Again, this is the count of households registering in cash flow stress with a mortgage. And you can see as we begin to pull out, once again, it's the same old story, with some areas doing okay, particularly closer into Melbourne, but as you pull out, you then start to see these more red areas. And in fact, we have red areas to the north, red areas to the west, red areas to the east of Melbourne, And as you pull out further, you then start to see places like Ballarat also showing up on the map. So again, you can see these quite big swathes around here between Frankston and out that way, Cardinia. And then you've got the area around Wyndham, and you've got the areas north of the city as well. So it does show you where some of the pressure really sits. And I will just do Brisbane as well. Okay. Now, the Brisbane story, of course, is also quite interesting because prices in Brisbane are sliding quite quickly. A lot of people have very large mortgages. A lot of people moved up to Brisbane through the COVID and post-COVID period, and they're starting to find it's quite awkward. And so what you're starting to see now is west of Brisbane, around Ipswich, places like that. Also in and around the city, a few areas. If you then go down to the Gold Coast, again, not quite as high because the population density isn't so high, but nevertheless there's quite a few people there who are beginning to register as stressed. And if you go further north up towards the Sunshine Coast, north of Moreton Bay and up further north, you can begin to see that there are some pockets there as well on the Sunshine Coast. So it sort of highlights the fact that wherever you look, you see pockets. And I think the thing that I'd want to emphasize here is that the pockets of stress are not just in those high growth corridors, but they are in a number of regional areas as well. And, you know, I could go around the rest of the country in some degree of detail. I'm not going to do that tonight because we'll just sort of tell you the story that you've seen before. But it does make the point, mortgage stress is a thing. Mortgage stress is definitely a significant issue. Now, you know, in some of the regional areas, you also got issues as well. So if you look at areas south or north of Sydney, or if you look, you know, around Melbourne as well, or up in Queensland, in some regional areas, and as I mentioned earlier on, places like Toowoomba, you know, is one that really jumps out, and there's a few others there as well. So, with that done, let me just come back to my scenarios because I want then to show you some of the granular detail that I've got in my model. So in the scenarios are ways of exploring futures. They're not predictions, not a forecast. And I use different scenarios to try and show the sensitivities. None of these scenarios may turn out to be right. Things change, but it is a framework that we use from our core market model, and we can look at the different outcomes as a result of that. And it's looking forward from today. So there's basically the best case scenario is RBA sticks at 3.1, and we see falls in interest rates over the next few months into next year. Inflation eases and wages rise faster. So we get no recession in Australia. That's the best possible outcome. Sidebar, you might also get some support from the government or some support from the RBA. You know, the APRA might change some of the parameters. Anything to save the property market. So that's the best case scenario. The base case scenario, though, is that rates rise further, let's say up to 3.65%, which will give you mortgage rates of between 6 and 7%. They stay high through 2023. Inflation stays above target until 2024, but no recession in Australia. Now, the RBA itself is saying that we're going to stay above target until 2024. And as I said the other day, and again this evening, the markets are saying 3.9%, so higher than what this base scenario is. Worst case scenario is we get even higher interest rates, with mortgage rates at 7% plus. Rates stay high, and we stay also with high inflation, wages growth stalls, recession really grinds and hits us here, and then they cut rates. So those are the three scenarios. Now you could run other scenarios, but those are the three that I've got. And if I take those, what I can then do is to give you a scenario based firstly for houses. In the best case scenario over the next 3 years from now, I'm expecting a small fall over the next couple of cycles and then a small rise. So we're pretty much back to where we are in 3 years' time. The base case scenario shows you a fall over 3 years relative to where we are now of about 21%. And the worst case scenario for houses would be a fall closer to 39%. And looking at units, the best case scenario for units is a small fall and then a slight return, pretty similar to houses. The falls for units will be slightly less in the base case scenario, so down about 18% over the next 3 years. And the worst case will be a fall closer to 34% over the next 3 years. So that's basically the scenarios that I have in my model at the moment. And I will just make this one. This is showing you that different segments have different scenarios too. So this is young growing families. So best case for young growing families is a fall over the next 3 years of about a couple of percent. The base case, 26%, and the worst case, 44%. So that gives you a bit of a flavour of what may happen. So the point to make is that some segments will see more significant falls than others. And that's partly because young growing families tend to be more leveraged. And in fact, units, roughly the similar trajectory for the best case. The base case, slightly less severe. And the worst case, again, slightly less severe. So you can begin to see. Now, let me translate that into something which is more specific. And we'll go over now to my sort of tool. This is the tool that I've got available. And this is my postcode level tool. So let me just switch it up. Source, that one there. Okay. So this is the current tool as at December 2022. And this is driven off the census data from 2021. And it's also taking my latest stress information and then running those 3 scenarios. So the 3 scenarios are here for units and for houses. This is postcode 2000, right? And this then gives us a scenario for each and also some other information, including the taxable income, the gross and net investment yields, and also the property price profiles, plus the mix between houses and units. So that gives you a bit of a flavour of what I've got. Now, I will have a quick look up here and just see what's going on. I'm going to do the Illawarra because it's close to my heart down here. Okay, so this is the latest for the Illawarra. This is postcode 2500. And the first thing to say is there's 19,000 households in the postcode, right? And 25% own outright, 24% are borrowing, and 49% are renting. And looking at mortgage stress, it's at about 27%, so it's not dramatic, but rental stress is high at 64%, some investor stress, and overall financial stress is at 48%. From a scenario perspective, cumulatively speaking, the best scenario will be a fall of about 5% over 3 years. The base case, a fall of 29%, and the worst case, a fall of 47%. That's for houses. For units, down 5.1, down 24, down 41%, based on those scenarios. And looking at the property mix, we've got 35% of houses, 52% of units, 11% are other types of property, including things like living over shops and other commercial premises. The people ratio is 2, so that's roughly an indication of the size of the family. And the vacancy was 9.8% on census night last year, with 1,900 properties in the area vacant. The gross investment yield is 3.3%, but the net investment yield is underwater, minus 0.1%. And from a taxable income perspective, you can see there that the individual ATO was 79,000, A household was 84,000, and that translates to a disposable monthly income of around $5,500 on average. And that means a typical borrower is paying about $2,400 per month, which is 44.2% of their monthly income. For renting, about $1,900 a month, at 35.7%. So you can see here why this is such an important conversation. And what I'm trying to get to is this concept of disposable monthly income, because the RBA is not really looking at disposable monthly income, they're looking at the sort of the gross. And a lot of the other calculations that are being done, and a lot of the bank underwriting processes are looking at gross income. But of course, disposable income is the real question here. So that's why my modelling comes to a different result, because I'm trying to get more granular. I'm trying to understand precisely how households are playing out. Now, if there are other postcodes you'd like me to walk into, I'm happy to do that. Or if there's a particular area where you'd like me to show my mapping, I can do that. Or I can answer any other questions that you may want to ask. So I'm just going to look at the chat now. I see that there's a interesting conversation going on with term deposit rates. This is one from Cookie Boy. Whoops, what's happened to that? Try that. There we go. Best 12-month term deposit, 4.3% with Illawarra Credit Union. Yeah, they're not bad. I got a 4.9% some time ago, but that was not with those, and that was just picked the right timing point. So 4.95% I've got at the moment, which I was quite pleased about, really. Okay. Public Melody Music asks for lawn. That's 3232. Yeah, can do that. 3232. Right. Let me get rid of that. Go there. Get rid of that. Okay, lawn. Now, I need to highlight that lawn is a very low count, which means that you can't necessarily take this as statistically robust. That said, more than half of people there own outright, 20% are borrowing, 24% are renting, 33% have mortgage stress, 50% rental stress, and financial stress is at 34%. Typical falls, best case about down 9% over 3 years cumulative, base case down 33, worst case down 51, and for units down 8, 29 and 44 over 3 years. Most of the properties, 85% are houses, small number of units. The people ratio is relatively low, and the vacancies were very high. Now, this is, of course, because it's a holiday area, 68% on census night, more than 1,000. Gross investment yield, 3.2. Net investment yield, down, minus, negative, 0.2. Average taxable, 94,000 per individual or 79,000 per household, according to the ATO, which gives you a disposable monthly income around 4,600, which means that the typical repayment is about 56.4% of that, whereas the typical rent's at 39.2%. So there's a few things going on there in that particular postcode. Okay, let's find another one. 4505, please. Let's do that one, shall we? Four five oh five. Burpengary. Okay, this is Queensland, obviously. 9,600 households. 27% own outright. 45% are borrowing. 27% are renting. Very high levels of mortgage stress at 92%, so more than 4,000 households with cash flow issues, and 77% or 2,000 of renters in rental stress. We've got some stressed investors as well, and the households are in financial stress at 67%. It's very high. Now, from a scenario perspective, the best case would be a fall of about 2% over 3 years for houses and 1.4% for units. The base case is a fall of 25% cumulative over 3 years versus 21% for units, and 43.3% is the worst case compared with 37.5% for units. 86% of properties are houses, and the population ratio, the people ratio, is 2.61, which is relatively high. Vacancy rate's pretty low. Gross investment yield is 4.5% on average in the postcode. The net investment yield is positive at least, but only 0.8%. And it is worth underscoring that, 0.8%. So without capital appreciation, that's the return you're making on an annualised basis, compared with more than 4% in the term deposit. So is it worth it? You decide. Average taxable income, 69,000. Average household income, 91,000. That gives you a disposable monthly income around 5,400. And 40% is going on the typical mortgage, and 32% is going on the typical rent in that postcode. Okay, let's do another one. 6100. You've asked for 2, I'll give you 1 to start with and see how we go, eh? So this is Lanth Lane. 7,300 households, 20% own outright, 30% are borrowing and 49% are renting. Mortgage stress is 25%, rental stress is at 65%, investor stress at 38%, so just over half of households are in financial stress. The best case scenario is a rise of 1.5% over 3 years, or 1.2% over 3 years for units. The base case is a fall of 21%, or 18% for units. The worst case, down 40 or 35% houses versus units. 43% are houses, 29% are units. Lots of other types of property too, including over commercial premises. People ratio is 1.85%. Vacancy was 12.3% in the census last year, 970 properties, and the gross investment yield 4.2. The investment yield 0.9, and the ATO taxable 90,000 household is 98,500, which gives a disposable income of about 6,200 on average, with 38% going on the typical mortgage and 28% on the typical rent. Then you ask for 6053. This is Bayswater in Western Australia, 6,400, with 25% owning outright, 46% borrowing, 28% renting, 38% in mortgage stress, 70% in rental stress, and overall financial stress is 44.6. Looking at the scenarios, positive 1.4% for houses, best case over 3 years, positive 1.2%. Base case down 22% versus 18%, worst case down 39% versus 34%. And looking at this, 80% are houses, small number of units, and the vacancy rate's 9.4%, pretty high, 637. Gross investments 4.2, net investment 0.8. And looking at the ATO, 87,000 compared with the ABS 105,000, giving disposable monthly income of 6,300, with 38% going on the typical mortgage and 27% going on the typical rent. So you can see that there's quite a lot going on there. Now let me just pause at this point because I wanted to do just this. I have, of course, been showing you doggy cam, but I've also got my other variable camera here. And this is actually the camera that's showing the state of the system here. This is me in real time. So I'm actually steering the camera and talking to you at the same time. And you can see there that I can drill in and focus in so you can see precisely what's going on. So I'm quite pleased with this. This actually gives me another variable view, as well, of course, as the doggy view, which is another one which I have. And you can see there that The system is quite complex. So I'm driving all of this at the moment as I'm making the show and sharing my information. So I thought you might be interested in seeing that. And I will just cut across the doggies while I'm here. This is with the doggy cam, of course. Oh, and Meteor's decided to get up and wander around. We're going to make our bed, I think. Oh no, we'll go around. Have you noticed how dogs go around in circles when they make themselves comfortable? I think that's a very, very cute little trick. And you can see there the doggies are very, very, very comfortable. Okay, so let me go back to what I was doing. I thought you just might like a little break there, and I certainly needed a little break. Going back up to the top and just see what else. Okay, try this one. 4655. This is Craig Niche in Brisbane. Put that there, go there, get rid of that. Okay, so this has got 28,000 households in the postcode with 43% owning outright, 29% borrowing, 27% renting, 9.6% in stress for the mortgage. That's pretty low, but 75% rental stress, 24% stressed investors, so just 29% in financial stress. So scenarios are these. Actually quite significant potential growth. Best case scenario, up 8.7% over 3 years for houses or 7.5% for units. The base case is down 14 or 12. Worst case down 32 or 28 for houses versus units. 84% are houses. And the people ratio is 2.13, that's quite high. That would suggest quite a few families in the area. Vacancy rate was also high at 9.1%. 2,600 properties vacant on census night. Gross investment yield is 4.6. Net investment yield is 0.7. Average taxable income, 68,000. The ATO reported a household income, according to the census, of 57,000, and that gives you a disposable monthly income of $3,654. Of which 47% is going to pay the mortgage on average, and 46% is going to pay the rent. So those are big numbers, and you'll see they're highlighted because they're actually quite high. Okay, let's pick another one, shall we? I'm always going to have this problem where I'm going to get too many and won't be able to do them all, but I'll try doing this one. Jackie says 3016. This is Williamstown in Victoria. Okay, 6,400 households. 36% own outright. 37% are borrowing. 26% are renting. 18.5% in mortgage stress, that's relatively low, but 73% in rental stress, that's pretty high. 26% stressed investors and 41% in financial stress. Down 5 over 3 years, the best case for houses. Down 5 and a bit for units. 29% full base case for houses, 25% for units, and 47% worst case, 41% worst case for units. 54% are houses, 13% are units, 32% are other types of property. People ratio is 2.2. Vacancy was 11.3%, 782 properties. Gross investment yield on average 3.4. Net investment yield 0.1, just slightly positive. Average taxable income 117,000. Average household income 123,000. Disposable monthly income $7,400 a month, with 41.8% going on the mortgage and 30% going on the typical rent. Okay, let me just pick this one up from Cookie Boy. Any news on the Bank of Mum and Dad? Yeah, I've run some numbers on the Bank of Mum and Dad. I haven't quite got them finished yet. I basically took a holiday over the Christmas New Year period, so I'm about a week behind my normal modelling, but I will be doing another show on the Bank of Mum and Dad. What I can say is that there is a bit of a fall in the volume of Bank of Mum and Dad loans because, of course, there are less first-time buyers coming into the market. But interestingly, the Bank of Mum and Dad is paying a bigger volume, a bigger sort of value where they're helping. So it's considerably above 100,000 on average now. So that's an interesting observation. And it's also interesting to see that some of those who actually were Bank of Mum and Dad borrowers, lenders, those Bank of Mum and Dad people are now worrying about their own equity because, of course, their equity is dropping because they were assuming they'd have plenty of equity as they move into retirement. Maybe they won't. So maybe that will also be a bit of a break on it going forward. Okay. Ken says $2.09. Do that. That's Piedmont, I should say. 5,900 households in the area. 17.6% are owning outright. 20% are borrowing and 62% are renting. Just 7.2% are actually borrowing and with mortgage stress. 84% are renting with rental stress. A lot of stressed investors in the area, though. That's because, of course, they're highly leveraged, interest rates rising, and so financial stress is very high at 68%. As a result of that, no surprise, the scenarios would suggest a price fall over the next little while. One of the very important factors to understand is how the stress data drives the modelling when it comes to what happens with regard to the price scenarios. The bigger the stress, the greater the falls ahead. Now, if I look at this, we can see there that the best case is a fall of 9 for houses, 7 for units over 3 years cumulative, down 32, down 28, down 50, down 44. And pretty much everything is units or other types of property. No standalone houses in the area, according to the census. And 14.2% were vacant, 927. The gross investment yield is about 3.9. The net investment yield is about 1%, so better than some areas. Average income, 115,000. Average household census, 125,000. And that gives us a disposable monthly income around 8,000, with 41.4% borrowing. And that means very big mortgages, 41.4% of disposable monthly income. Renting, 35.6% of monthly disposable income. So highly leveraged and people definitely feeling it. Remind you to like the post and subscribe if you haven't done so. It really helps to get this out into the big wide world. Or if you do, click and like, subscribe. Really is appreciated because it helps us to get our message out. Vincent says, can I do 3127? Sure can. Okay, so 3127 is Surrey Hills in Melbourne. 7,300 households, 39.2% own outright, 36.9% are borrowing, and 23.8% are renting. And 25% are mortgage stressed, 66.7% rental stress, overall financial stress, not too bad, 35%. And looking at the scenarios, best case is down 5 for houses or 4.5% for units. The base case is down 28% for houses or down 25% cumulative for units. Worst case down 47 or 41. 63% are houses, 11% are units, 24% other types of property. And the people ratio is 2.34, 8.7% vacant, 3.2% gross investment yield on average. Net investment yield is underwater, minus 0.3%. Typical ATO, 124,000. Typical household census, 127,000. And that translates to a disposable income of about $7,100 a month, of which 47% is going to pay the mortgage and 32% is going to pay the average rent. $2,913. Sure can. Okay. So this is in the Canberra area. 14,600 households there. 2,532 or 17.3% own outright. 53%, 7,773. 53% are borrowing, highly leveraged. 29% are renting. Mortgage stress is at 20%. Rental stress is at 80%. And overall, we're looking at households in financial stress of about 38%. From a scenario perspective, over 3 years, houses down just over 1 and a bit percent. Units pretty close. Base case down 24 versus 21. Worst case down 42 versus 37 for units. 68% of houses, 7.3% of units, and 24% of other types of property. And the vacancy rate was just 4.3, 619 properties. The gross investment yield's 4.4, net investment yield's 0.9. Average taxable income was about $85,000, individual ATO, and household census 126,000. And that translates to a disposable monthly income around $7,400, which means that 32% is going on the typical mortgage and 30% is going on the typical rent. Okay, Julie says, Southern Highlands map or postcode 2577. Okay, well let me just do the postcode first. 2577. Okay. Now, it's worth saying, of course, this is quite a large area, including Kangaroo Valley and Moss Vale and etc., Robertson. So it's a bit spread out. 6,700 households, 41% own outright, 36% of borrowing, 21% of renting, 28% in mortgage stress, but a lot of renters in rental cash flow stress, and some stressed investors, but 34% of households in financial stress. So the scenarios are, best case down about 6% over 3 years for houses, or 6% for units, down 29 versus 26 houses and units base case, 48, 42 worst case houses and units, 91.6%. And houses, 1.8% of units. And you can see there the people ratio is 2.13, 13.6%, or 998 vacant, 3%. Gross investment yield flat in terms of net investment yield. Average income from the ATO is 83,600. Household census said 86,688 per household. Disposable monthly income around 5,800, with 41% going on the typical mortgage and 34% going on the typical rent. Now, I will just, because I'm quite interested in this, 2577, if I put this into my map. Okay. I have to pull out a bit because it's such a big area. Right, so you can see there that 2577 is, let me just change that so you can see the whole thing. There you go. Yeah, so you can see there that it's a little lower in terms of stress than some of the surrounding areas. So you can see over towards Goulburn it's a bit higher. And then, of course, up here you've got Campbelltown and other areas south of Sydney. Some of the areas around Wollongong as well, particularly south of Wollongong, down Shell Harbour Way as well. So that just gives you a bit of a flavour of what's going on there. I'm going to switch it back to the other one, and then I'm going to switch back to that. There we go. Okay, now what else have we got? I'm just going to talk about this for a bit. Danielle's asked a very good question. Can we trust the liquidity of the banks? Interesting question. Depends what you mean, I suppose, by liquidity. So the question is, are the capital ratios that are reported robust and accurate? Probably they are. They're certainly higher than they were. And the disclosures that the banks have to make are significantly higher than they were pre-global financial crisis. So I think the short answer is the capital numbers are probably right. What is not clear in my mind is whether they have the provisioning correct and whether they know that the risk that they have in their own portfolios. It's a bit like I said earlier on. A lot of the banks do portfolio analysis, not individual granular analysis. One or two are starting to do postcode level analysis, but many aren't at the moment. And if they don't actually have that, the question is, do they have enough information to know precisely where they are? The other question, of course, is to what extent are banks exposed to derivatives? And many of the large banks in particular are exposed to taking positions and trying to make money from those positions. And of course, with the volatility in international financial markets, they could actually have liquidity issues because of the volatility of the derivatives. And again, the disclosure on derivatives in Australia is pretty low. They actually report less about derivatives than today. So it's really hard to know. APRA will tell you that the banks are unquestionably strong. And yet APRA put a counter-cyclical buffer in place of 1% starting from 1 January. So do they know something we don't? I don't know. So it's very hard to know precisely where we are. My own reading would be, I think, that the banks are relatively well positioned from a liquidity perspective, but I think they do have some risks in their portfolio. And if in fact the delinquency rates start to rise, that could actually turn to custard quite quickly. One of the reasons that's important is because if they have delinquencies, they have to allow more capital against those delinquencies. That means they need to hold higher levels of capital, and that means they could have liquidity issues. Other point to make, of course, is they have these liquidity coverage ratios, which means they have to have a certain amount of their assets in very liquid forms, which allows them then to access them quickly. And they have improved those as well, and they do report liquidity coverage ratios as well, which are not bad. So I think whether you can trust it or not, hard to know. But my own view is there's probably not too much there to see in the short term. In the medium and long term, who knows? And I'm sorry if I can't be more explicit than that, but that's what I think about it. Okay, Osborne Digital Marketing. Hello there. Yep, hope you're doing well as well. 3981. That's right, 3981. Yep. Okay, let's put that back up. Get rid of that. Okay, low count. So be careful with these. Statistically, these may not be as robust and accurate as some. Just under 2,000 households, 26% own outright, 56% are borrowing, 70% are renting. Not much mortgage stress, but a lot of rental stress. Scenarios are small falls for houses and units. Best case scenario, base case down 25 or 22, worst case down 44 or 38. 92% of houses, small number of units. People ratio is quite high, so probably a number of families. Vacancy rate's quite reasonable, 6.5%, 130 properties there. Gross investment, 3.3, net investment, minus 0.7. Average taxable income is 67,000, household income, 91,000. Disposable monthly income on average, just over $5,000, with 42.9% going towards the mortgage and 30.2% going towards the rent on average. Okay, here's another one. You're welcome. And I'll just acknowledge Hayden there. Thank you very much for that, Hayden. I appreciate the super chat. Thank you very much for contributing. Greatly appreciated. Really helps to cover some of the costs of what we do. Thank you. What else have we got? Martin says, Cairns held up well compared to the rest of the country. Maybe. Though actually, if you look, I think it's starting to tip over. And of course, the growth levels in Cairns was not as strong as elsewhere previously. So it's a matter of where you take the measure point from, I suspect. Two fairy assistants says Aussie Jean, and in fact, there you go. Luna's standing up at the moment. Not sure what she's doing. She's trying to unmake the bed. I make the bed, and then she actually goes and spends a lot of time unmaking it. I don't know what this. If anybody knows about dogs, I don't know what they're doing, but they both do it. They both sort of dig up and scrape around and basically have a great. So I tidy the bed. They untidy it. Wacky. I don't understand dogs. Anyway. Okay. How are we doing for time? 9:22. Okay. I'm not going to get through all these postcodes. I can tell you that now. 3340, pretty please. Pretty please. Very good. 3340. Okay, so that's Bacchus Marsh. Put that one back up. There you go. Into there. There we go. 9,600 households. 25% own outright. 53% borrowing. 20% are renting. Mortgage stress at 58%. Rental stress at 64%. And overall financial stress 46%. Down 5 for houses or 4.7 for units, best case. Base case down 29% versus 25%. Worst case down 47 versus 40%. Typical 90%, mostly houses, few units, not a lot. People ratios 2.4, vacancy 6.1, gross investment yields 3 versus minus 0.4. Average taxable income 76,000 versus 93,000 for the census. That's per household. Disposable income just over $6,000, with 34% going on the typical mortgage and 27% going on the typical rent. Bossman says, can I look at 4510? We can try. Okay. Get rid of that. So this is Caboolture. 20,900 households. 23% own outright. 37% are borrowing. 38% are renting. 12% are in mortgage stress. 81% are in rental stress. 31.5% are in stressed investing, and 45% overall in financial stress. So there's still a potential scenario where there's a rise, best case, over the next 3 years, up 6.5% for houses or 5.6% for units, but base case is a fall of 16 or 14, worst case a fall of 34 versus 30. 83% of houses, small number of units. The vacancy rate was 6.9% at 1,400 on census night last year. Gross investment 4.7, net investment 1.2. Quite often see that. The better returns up in Queensland relative to other parts of the country. Average taxable income 62. Average household income is 68. Typical monthly disposable income 4,400, with 43% going on the average mortgage and 36% going on the average rent. Alison says 4380. 4380. And that is Stanthorpe. So 3,300 households, 44% own outright, 29% are borrowing, 26% are renting. Borrowers in mortgage stress, 45%. Renters in rental stress, 42%. Stressed investors, 16%, and 27% in financial stress. So because of that, there is a potential rise of best case 9.2% over 3 years, or 7.8% for units over 3 years. Base case down 14 or 12. Worst case down 33 or 27. That's because of the low numbers here. 90% of houses, 17% were vacant, 663 on census night, 4.6% gross investment yield, 0.8% net investment yield. Average taxable income about 60,000 or 53,000 in the census per household, which gives you a disposable income of 3,600, with 43% going on the average mortgage and 34% going on the average rent. Okay, let's see what else we've got. By the time I read that, thank you. Good night indeed. Well, we're running out of time, aren't we? 9:27. I think I want to do now is I want to go back to my presentation and just give you a couple of last thoughts, and then we'll see where we go from there. Now, one of the things I just want to underscore, given where we are with pressure on households, is some people don't know how to deal with this, and I get quite concerned when I get requests for help. What do I do? So I always refer people to the debt helpline, the National Debt Helpline. Now, this is a government service. It's on 1-800-007-007. And these are trained financial counsellors. They are very busy at the moment. A lot of people picking up the phone and talking to them. But I would recommend them over against a whole bunch of other organisations who are out there claiming to fix your credit or claiming to deal with debt problems on your behalf, but then charging you for it. There are a lot of, I think, unscrupulous businesses who are taking people who are in financial stress and difficulty to the cleaners. Therefore, National Debt Helpline is a number to just have in the back of your mind. 1-800-007-007. It's recommended. And there are things that can be done to help if people get into difficulty. First thing is recognise you've got a problem. The second thing is then to drop a cash flow so you know where you are with money coming in, money coming out. And then knowing what rates you've got, interest rates, and then being to prioritise. Now, the debt helpline can certainly help do some of that. What I would say to people is this: with the current trajectory of interest rates and with the proportion of disposable monthly income that many people are throwing at mortgages and rents at the moment, people are in significant pressure with their finances, and it's going to get worse. So it's very important to think ahead and plan ahead. Cash flow is really important. Prioritisation is really important. Reach for help. Don't just try and ignore it and hope it'll go away. In the current environment, with higher interest rates, with real wages going backwards, with inflation still there, people are going to get in more difficulty unless they start addressing it. So, I always, at this point in the show, say it's worth taking the time to getting to deal with it rather than just hoping it'll go away. In the early 2000s, income was growing a lot faster relative to the cost of a mortgage, and so people got out of jail. Scenario is very different today. And I have to say that I don't believe that we're going to get a rescue package from the government or from the RBA. So I think we are going to see interest rates higher for longer. I think we're going to see mortgages driving prices lower because people's affordability is much worse than it was. So therefore, that's going to put more downward pressure on home prices. My own expectations, as you saw from my scenarios, is that scenarios are pointing downwards rather than not even CoreLogic is suggesting further falls. So it is worth getting help if you need it to try and sort this out, and quite soon. Now, just in terms of if you want more information about what I am up to, you can go to my blog, digitalfinanceanalytics.com blog. There is also a chat feature there. And if you are unsuccessful in asking me for a postcode on the show tonight, and you still want a postcode, you can send me a message via the DFA blog. And if you ask for one postcode, I'll be able to send you that over the next few days. If you put a long list down, I won't be able to do them all. So just be selective. Or indeed, you can always go for the one-to-one service, of course, which is a more detailed, granular analysis of a particular area, including the sort of data I've been showing this evening. If you want more information about what we do, you can also subscribe via Patreon to support our work, or you can get the data set that's driving this modelling that you've seen tonight. And that is available, and I do have a number of subscribers who actually subscribe. This is some $50 US a month plus GST, and I'll be sending it out tomorrow for those on the Patreon program who've actually up to date with their payments. So you'll be receiving it over the next 24 hours, and that will give you the full breakdown for all postcodes in Australia with all the information that I've been showing tonight. And a number of people use that to make hopefully good decisions. You can also make a contribution via PayPal if you'd like to support what we do, by the way, and those are greatly appreciated too. Or indeed, I even still, even where Bitcoin is, still can receive Bitcoins. And there's also some merch on the site if you're interested in that. Now, let me just talk about next week. There's going to be a special show next week. It's Rennick versus John Adams. So Senator Rennick versus John Adams, the ultimate showdown. And we're going to talk about monetary policy, the RBA, what should be done, debt, all of the big questions. So that should be worth watching. It'll be a bit in a debate format. So mark your diaries for that, and that should be definitely worth watching. So it's on the show next week. Okay. So I've got to the 9:33, and I think I'm going to call it quits now. So I want to say thank you very much for spending some time this evening. Sorry if I didn't get to your postcode in the show tonight. There was always too many, unfortunately. I never can get to all of them. But if you would like a postcode, data point, you can contact me via the blog, and I'll turn it through over the next few days. It won't happen tonight, but over the next few days. And just an acknowledgement of Jason. Thank you very much. I appreciate your comment there. Thanks for the super chat. And I agree. Please like the show, share, subscribe. Please share this information. I think this is more important than ever where we are at the moment on our journey. And Vanessa says she's tuning in next week. Good, it should be fun. Imagine me trying to control those two. It'll be very interesting. But I appreciate all those comments and the sharing the. Glad to share the data as well. And I guess the reason for showing the individual postcodes is to try and show you how granular you have to get to really understand what's going on. So with that, one last look at the doggies. That's Luna. And Meteor is at the other end. They've hardly moved at all. I think I shall come back next time as a dog. They look pretty comfortable there. So thank you very much for spending some time with me this evening. I hope you found it informative, interesting and thought-provoking. I'll look forward to catching up with you next week on our next live show. And in the meantime, check out our recorded shows. There's some stuff coming up over the next few days, which is quite interesting. And I'll look forward to seeing you next week. And in the meantime, please like, share and subscribe. Have a good evening. This is Martin North from Digital Finance Analytics signing off. We'll see you next time.